Well, hello to you all. Welcome to our webinar tonight. We're very excited to be introducing a brand new sponsor to the Wealth Migrate platform and launching their very first deal with us on the Wealth Migrate platform. And please, from wherever you are in the world, please do say hello. We do this at the start of every webinar, as you know, just to make sure, firstly, that you know where the question panel is, so that you can ask questions later, but also so that we can connect with our global community who is joining us tonight. So please, if you could just go to the question panel and drop in from which part of the world you're listening to us tonight. And if you've got any specific questions, if you've already had a chance to read through any of the material that we're going to be presented tonight, and you've got any questions, please drop it in immediately so that we can start engaging with you on those questions right from the beginning. And then, of course, a very good evening to Lee, our community manager. Lee, you're not on the other side of the world from us today. You're in South Africa. It's great to have you on the continent again. It's been a while.
It is fabulous to be back in Africa and feel African soil under my feet. I'm loving the rain, not so much the humidity here in Kloof in KwaZulu-Natal, but the rain has been glorious. You actually miss a good afternoon thunder shower when you haven't had it for a while. So it's great to be here and to be sharing with our community again.
Well, Lee, thanks. And for all of you, Lee tonight will be monitoring the question panel and interrupting us as we talk, because often, as you know, we can talk a lot. And Lee will be there just to make sure we're dealing directly with your questions. So please, throughout the evening, just drop your questions into the question box, and it'll be great to answer those for you. And then a really big welcome to Ricky and Robert. Guys, thanks for joining us from REM Capital. Good evening, or well, good morning. What time is it in the world where you are today?
Well, it feels like noon, but it's actually, I think, 10 o'clock in the morning. Just landed in Denver, so we're all over the place.
Yeah, on my
Robert,
side.
Great, welcome to us from Denver. And Ricky, where are you today?
I'm in Atlanta, so for me it is noon still. We're just at 12 o'clock this side, and yeah, thanks for having us on the call today. I really appreciate it.
Yeah, no, so we're really excited to be having REM join us as a sponsor, the partner on the Wealth Migrate platform. And my suggestion is let's start right there. So before we get into who REM is, if I can, I'd just like to, for all of you who are either on the platform right now because you're wanting to view this or going to go on it first, you'll note that in our marketplace, if you come down to the second layer, it says the views of Mt Airy, and there is REM Capital. And as you should be used to by now, if you just click on it, it will open up the deal page that has all the information you need to know, and that will be presented tonight. The presentation tonight is uploaded onto the platform already, and if there are any additional information, we will add that in addition. The documents are here. There is documentation. Sorry, let me just get down to the documentation piece. We have the deal structure memorandum, as well as the brochure, the information they're going to be taking us through tonight. Ricky and Robert, tell us a little bit about REM Capital. Who are you guys? What are your specialities? Both of you individuals, what's your passion? What's your background?
Thanks, Lyndon. Good to be here, and I apologize for the announcements in the background. So hopefully we'll figure this out. And I was going to say before I answer that, nice website. It looks really good. I hadn't seen it until just now. I might have to borrow some of your wording. It was very well done. But anyway, great to be here, guys. And always fun to talk about what we're working on and tell you a little bit about who we are. As a company, we're relatively new. We have been in business for about 3 years now. So we started with kind of the goal of providing I would say a little bit of a unique value proposition for our investors, kind of combining 20, 30 years of experience with the ability to invest in multifamily, and understanding that where we're at in the market is, there's a lot of questions around it, which I'm sure we'll get into in a minute. And we really felt like because of our experience and because of the transactions that we've done in the past, we could bring that value to investors and provide a really, a good return without taking an additional amount of risk. So been at it for 3 years. We've closed 5 deals. We've got a few under contract this year, so we're excited about that. We've had some good traction. And, at the end of the day, our goal is to take our time to put in the work that it takes to find a good deal, because right now, obviously, it's challenging. It's a very good market and has been for the last 10 years. So we put a lot of time into that, and we feel that that's worth the effort. But I think at the end of the day, if we can find something that meets our criteria, that gives us a good opportunity to make a good return while not taking too much risk, it's well worth it. So that's kind of our background.
Absolutely. And
Great, Robert. I noticed you mentioned that twice. Before we get to you, Ricky, Robert, I noticed you mentioned twice. I really get you emphasizing the point, good return while minimizing risk. I see on the write-up that we have here on our website, you talk about a conservative approach. We'll get into that in a little bit, maybe in 3 or 4 minutes, around what is your approach, what are you looking for? But first, Ricky, it's almost like a family reunion. For many of our investors, they will recognize Ricky as having worked with Wealth Migrate about 3 or 4 years ago, before Ricky decided to go to greener pastures, maybe in the US. But Ricky, it's great to have you back. Tell us a little about where you're at the moment and what you're up to.
Yeah, perfect. Thanks for having me back. And to those investors that recognize my face, it's good to be working with you guys again. I just wanted to touch on some points there on Robert's side. I think he's playing the humility card, but he's got a lot. The company might be 3 years old, but he's been doing this for the last good 20 plus years. And maybe he could speak a little bit later as to his track record and where he worked beforehand, and just allude to that a bit. But further to the point of it being a tough market, I think it's important to mention that we've probably looked at about 33,000 doors to get the last, call it 500, 600 under contract. So it definitely is a numbers game in this market that's really doing well. But like Robert said, just to reiterate that, is when you know your parameters and you know what you're looking for, you just got to keep working through the numbers, and eventually the right deal lands and sticks. So we're really confident with what we've got under contract at the moment. And speaking for myself, yeah, I'm between Cape Town and Atlanta a lot of the time, spending more and more time here in the States, hoping to settle here for the next 2 years after Kaylee and I have had our little one in July. So we're quite excited to be spending more time in the States here and working as part of the acquisitions team at REM Capital. And it's just been a privilege working with Robert and the rest of the team. I like to associate myself with quality and with good leadership, and so I'm really excited with their team.
Great, thanks, Ricky. Appreciate it. I am curious, and the first question has come through already from Kim. She's saying, what makes this a tough market? Robert, you mentioned it was a tough market, and I think that's probably a great place to start any conversation where we're looking at investing in real estate, whether it's in the USA or globally. A tough market. Why do you think it's a tough market at the moment?
Well, I think there are a few factors contributing to it. One, we've had, at least in the US, I haven't tracked international as much, but in the US, we've had a decade of good real estate market. So the more time that goes on, the more people are interested in investing in real estate. And of course, the more people that are interested, it tends to drive the price up. So it's more difficult to find opportunities. The other thing is that we've had a huge influx of foreign money as well, for various reasons, exchange rate, political risk, etc., which is fairly typical, but I think we've continued to see that. The interest rate environment in the US is positive, so people are able to get a good return on their investment versus other places where they may be investing just to get an appreciation and not an actual cash flow. So we've had a lot of money coming in that's interested in that. So, you combine that with a relatively stagnant supply, especially in the market where we are, which is the existing product, the B and C product in the market, where you're not, the cost doesn't make sense to build it. And so, yeah, it's been tough because a lot of people are out there. They are looking for these deals. They're trying to buy them, reposition them. And really what it comes down to a lot of times in our business, and Ricky knows because he's front lines on this, is just developing a relationship with people that are in the market where you're at. So whether it's Atlanta or Cincinnati or Dallas or whatever it is, developing a relationship with the brokers, the sellers, developing it, but also becoming a known entity, a known quantity in that market, so that when a deal comes onto the market, or maybe before it even comes onto the market, they call us and they say, hey, we know you guys close. We know you're reasonable to deal with. We know you're good for the money, and we'd like to show you the deal. And so that's really what we've focused a lot of our time on, is building that track record, that reputation, building the rapport, so that hopefully we get a shot at these deals before they get too mass marketed, and then, you know, the price gets bid up and it doesn't make sense. That being said, we're still, I don't know, 200-300 deals to get one decent deal. So, you know, it still takes a lot of work, but they're out there if you're willing to do the work.
So Robert, you mentioned something interesting there. You said a lot of people are wanting to get into the market at the moment. There's a lot of investors looking around, a lot of other companies similar to yourselves looking for those deals, which is good news for investors in that it means they, you know, if they're doing what a lot of other people are doing, it's not necessarily a bad thing, but it could also be bad news because it means that almost that the market's getting to a potential peak. Do you have a sense on that? Do you have a sense as whether the US market and is it particularly in the multifamily space, or do you think it's across the board?
Yeah, I think that's a really important question to ask for many reasons. And just to digress for a second, one of the things that I tell every single one of our investors is it's really, really important to get to know your sponsor, because when you're at a place in the market like we are today, whenever the market corrects, and we don't know, but it usually does, the guys that know how to actually operate the business are the guys that are going to survive, generally speaking. Now, I don't mean to say that, you know, everybody's going to go out of business, but you really want to know that the people you're investing with know how to actually operate that business. And of course, secondly, maybe firstly, you want to know what kind of character and integrity they have, because when push comes to shove, how are they going to respond? So I really advise everybody to get to know their sponsors. You know, I understand it's difficult when you're halfway around the world, but we try to do the best that we can to, you know, do things like this, get on a webinar, emails, put things on social media, that kind of thing. But I think that's really, really important. Now, getting back to the economic question and the market, yes, we have seen a lot of people that are entering the market, and I think you have a lot of people that are not experienced that are making decisions and buying properties, and they're overpricing those properties, and that's a big concern of ours. But I think at the same time, if you partner yourself with an operator that knows what they're doing, has the experience to identify those risks and then mitigate those risks, I think at the end of the day, you have to ask yourself, am I smart enough to time the market? I don't think anybody's smart enough to do that. I've tried it, it didn't work. So, you know, you read about the stories of the hedge fund guys, but they got lucky. They really did. I mean, sure, they had a plan, but they got lucky. So I grew up in the business with the philosophy that you can make money in any market, but you have to know the risks of that particular market cycle, and you have to be able to mitigate them. So, you know, we can get into some of the details of what we're doing currently, but I do think that there are risks out there. There are people that are overpaying, and one day they're probably going to get hit. But that doesn't mean there aren't good opportunities out there. So I really think it comes down to partnering with somebody that understands that and is prepared for what may come, and isn't just saying, you know what, it's just going to always go up, everything's going to be great, the world is never going to correct. I think that's a risky proposition. So that's kind of the way we look at it. Can't be smart enough to time the market, but if you sit on the sidelines, well, what if it goes up for another 4 years and then you missed out? You don't want to do that either. So I think you need to be invested, you need to be in the market, but you've got to be smart about it. And that's kind of the way we look at it. So hopefully that kind of answers your question.
Yeah, absolutely. So Ricky, as the guy in the front line, what are you looking for? You said you said to get 500 doors, you might have to have a look at 30,000. What is it that you're looking for that you think is getting REM Capital to a point where, as investors, we know that what you're looking for is the right thing, in particular facing the uncertainty? What is it that you are looking for in that deal?
Sure. So we've got quite a broad criteria in terms of a number of things, and then we've got very specific criteria that we like to do in terms of stress testing and managing downside risk. So when we're looking for deals, we're buying a range of products, but maybe just talking more specific towards the risk mitigation side of things. And Robert can obviously chirp in here when necessary, but I think some of the things that we're looking to do on the front end is just running the vacancy tests. So just seeing at what point in time vacancy or the occupancy of that building at what point does it break? From two perspectives. The first and foremost is obviously more around your actual servicing of your debt, so making sure that you can service debt at a certain level and that you're meeting all of your loan covenants or requirements from the lender in terms of what can and can't be done there. And then most importantly, in my opinion, when we're running a value add model in particular, is to look at what are the surrounding properties operating at, what kind of rents are they achieving, and are we putting things on a spreadsheet that we're never going to realize in reality. So we're looking for strong support in the local market and in comps or competitors that essentially already exist and that are already achieving those rents or something close to them from a value add perspective, because obviously the name of the game for what we do is a value add strategy, and the pure execution of that plan revolves around increasing rents and doing through a renovation program. So we really want to be sure that we are looking to be able to raise the rents to the same level as some of the comps in the area, and we want to bring a better product at a lower price is obviously what everyone's striving for. So we like to be very aware of what's going on in that market, what's taking place in terms of pricing, what competition possibly paid for some of those other deals, the things that we're looking at and considering the cost of capital there. And then we're also obviously looking at if things didn't go according to plan, what does that look like? And are we at risk of losing the property or defaulting on the loan? So I think that's probably first and foremost the most important things that spring to mind. I don't know if you've got anything to add to that, Robert.
Yeah, and you got most of the points. I'll just add a couple things. One is when we look at a deal, we're looking at it from a cash flow perspective. So while we may get appreciation and that's wonderful, we're looking at it saying, okay, what if we didn't have appreciation? What if the market flattened? Are we buying a quality asset? Is this asset in a good location? Does it make sense to buy it? Now, I think long-term we will see appreciation because historically that's always been true. But in the interim, what do we have in terms of cash flow? And then we went back and we looked at all the markets that we're in, and we looked back at 2008 and we said, okay, what happened to these markets? Where did they bottom out in terms of vacancy? Because again, we're looking at cash flow. And typically they've bottomed out at about 80 to 85% occupancy. So what we decided is, okay, when we do our deals, we're going to stress test them all the way down to 70 or 75% occupancy, and we want them to cash flow. The idea behind that being that, hey, if 2008 happens again, which I don't think it will, but if it did, we're going to be in a position to continue to service our debt and even give a little bit of a return to our investors while we maintain that property. Now, again, if it wasn't a good quality property, that wouldn't make sense. But if you buy quality and you hang on to it, it makes sense. So those are one of the things, that's one of the things that we look at. Second thing is we feel like even that we can add to that. And so we do 6 months of working capital for all of our properties. So even if we go to 50% occupancy, we could probably survive for a year or two. And typically a downturn lasts for a couple of years. So I know that sounds a little crazy to some people and they kind of look at me like, gee whiz, you guys are a little pessimistic. But the question is, how much capital are you willing to risk in order to get your return? And I have a little slide that I don't think we have on ours, but it basically says, you know, if you get a 15% return and you have to risk 50% of your capital, does that make sense? If you could make a 10% return and risk none of your capital, for us, that's a better ratio. So that's kind of how we look at it. And again, it's based on data, based on experience, but we feel very strongly that even though we don't know what's coming, if we're prepared, then we'll be fine and we'll be able to make it through. So.
Yeah, that's great, guys. So I think in terms of a theoretical perspective on where you're coming from, I think that's really fantastic. It gives us a sense of how you play the market and where you want to position yourselves. So let's talk about this deal specifically. And Ricky, I'm going to switch. I'm just going to stop sharing quickly and switch across to you as the presenter. So give me a second here just to change the presenter. And then I'm going to actually hand over.
Got it.
There you go, Ricky. It should be coming your way. So just let me know when you are when you have it.
Okay, you should be seeing my main screen. Is that correct? Are you seeing this screen now? Yeah, looks like it.
Yep, that's good.
You should have it in front of you.
Yep, perfect.
Great. So I think just to summarize, we spoke a bit about it offline. So I'm sharing the screen on my side, but Robert, you're going to be letting me know when to switch over slides. So we can begin on this particular project, which is called the Views of Mt Airy.
Perfect. All right. Well, we can go to the second page. There we go. So just to kind of give you guys a little bit of a, and of course you've got access to this PDF. This is the attachment in the on the portal. But basically, it's a 282 unit. It's a C-class multifamily. Now, some of you guys may not know the classes of multifamily. There's basically A, B, C, D. A being the high end, D being you don't want to go there. Well, unless you have a gun with you. But anyway, so we tend to focus on what we call the middle market, which is the B and C class. It's anywhere from working class up to what I would say is like a dirty white collar. So a legal assistant, you know, a manager on a factory floor, something along those lines. And the reason that we like to focus on that market is because, like I mentioned before, there's no new inventory in that particular space. So you cannot build a new inventory for the price that we're buying it at. So in this particular project, we're buying it at about a third of what it would cost to rebuild. And the whole idea here is that we've got the supply, there's an increasing demand, and so over the long run, we're going to see appreciation. That being said, part of the appreciation also comes from renovating the interiors because these residents want a nicer place to live, and so we're able to bring them over to where we are. So, Ricky, you can go to the next one.
Sorry, Robert, can I check? Did I hear you correctly? So to rebuild, would you're buying it at a third of the rebuild cost?
That's correct, yes. Yep. Pretty good deal, right?
There's some food for thought for the rest of us.
Well, and you know, sorry, not to digress too much, but that's actually one of the things that we look for when we go into a market is, you know, if we're buying it at a price that's fairly similar to cost of construction or cost of buying a house, that's generally not a good ratio. We want to see a proposition where, you know, we're able to have a unit cost that's significantly less, because again, then we're able to provide value to these residents that they wouldn't be able to get otherwise. So it just helps, you know, it's the old supply and demand curve. If you're on the right side of it, generally speaking, over the long run, things are going to move in your direction. So second slide is just kind of a summary of the investment highlights, although I believe the minimum is a little bit different for you guys. So this is what we present in the US. But in general, our investment term is 5 to 10 years. Now, I always have people that say, well, wait a minute, that's a long time for my money to be locked up. So there's a little bit of a nuance inside of that. Generally, what we do on our projects is we go in for the first 2 years, we implement the renovation and the, you know, repositioning the property. That, of course, enables us to raise the rent, which then raises the value of the project. We're then able to go back to the lender, request an increase in our loan, which we then return back to our investors. So the goal for us is to get everyone's initial capital back to them within by 5 years. Now, not all through capital, but distributions and capital, we like to get all that initial investment back. So the goal is by year 5, let's call it, you've got all your money back, but you still own a piece of the investment, and you're still getting cash flow, and you still have the appreciation upside. So it's kind of a very tax efficient and risk averse strategy, if you will, but that's our goal. Now, in terms of returns, on this particular project, we're looking at about 10 to 13% of a annual cash on cash return, and that's averaged over 5 years, and then a projected IRR of 16 to 18. And that's fairly similar across all of our projects. We target a minimum of 10% cash and 15% IRR. So this particular investment is a little bit higher, but it is in a very good part of the country. The Midwest area of the United States typically offers us a little bit of a higher yield, which is nice. Now, we wouldn't want to exclusively be in this area, but when we do have investments in this particular area, it's a little bit higher yield, so which is always nice. So, Ricky, you can probably skip the
for a second, if I can. So firstly, as Robert mentioned, to all our investors, you know by now, one of the advantages of investing through Wealth Migrate is we take deals that are normally available only to the to the WealthE, you can come in at 100K at a time, and we break that down so that you can get into this in the USA in a great market for less than that. Our starting minimum on this one is 10,000. You all should know about WealthE Wednesdays, the first Wednesday of every month, where we do drop that to make it more accessible, but generally it's 10,000. The other point that really interests me, Robert and Ricky, when I had a look through the actual information, it seemed that you were trying to get a significant chunk of that capital through that remortgage process by about year 3. So just so that the investors can understand that, let's say you put in 1,000 up front. By year 3, they then go and get another mortgage and are able to pay you 600-700 of your initial investment back at that point. So that, as Robert said, by the time it gets to year 5, you will have your full money back from dividends that have been paid out, from that recapitalization of the business, but you're still in the game. You're still there for the upside to get continued revenue if they keep running the deal. But if they sell it at that point, then you're part of the upside, even though you've already got your capital back earlier. So that's unique because none of our other sponsors do that. So Robert, is that something that is fairly common in the market? Is it something that we haven't come across it before from our sponsors? It is a particular piece that you and REM Capital like to put in deals?
I think it is somewhat unique. And part of the reason that it's unique is because most sponsors would prefer to fix the property and flip it because they make a lot more money when they do that. As you can imagine, most of our equity is tied up in that property. And so unless we sell it, we're not going to get that equity. So from a sponsor's perspective, I can understand why most operators want to fix it up and flip it so they get their money back. Now, the downside to that is that I don't believe that's the best, that's in the best interest of the investor. And we we invest in every single project. So we're investors. And so, we look at it from that perspective saying, well, what's the best thing from an investor? And we really believe that the best way to do it is you take your risk off the table and you hold on to that project. So, it's, I would say it's kind of taking a little bit of a different approach, looking at it purely from an investor's perspective. And, but at the same time, I understand why a lot of other operators do that, because it certainly puts more money in your pocket as an operator if you sell the property and you don't keep your investors in the deal. So, but one other thing I do want to mention with regard to that refinance is that I have also seen some folks who will refinance their property, and what I think they over leverage the property because they are excited about getting all the money back. And we could do that too, but we've made a specific decision that even when we go to do that refinance, we're still going to stress test that property to make sure that even once it's re-levered, we still have the ability to have this very large fudge factor. So again, we could probably return 100% of that money in terms of the capital distribution, but we've just decided that, we're going to hold this long term, and we want to make sure that it's set up for a sustainable, successful future. So anyway, just wanted to mention that.
Great, thanks. So I've got a question here from Martin. Martin asks, your 10 to 13% cash on cash return, is that starting from the beginning, or does it escalate over time? So in other words, are you starting at a 7%, then an 8, then a 9, 10, 11, 12, 13, or are you pretty starting flat and maintaining a 10 to 13 from the beginning?
Well, great question. Yes. So we are escalating, and there's a slide in here that kind of shows that, but we are escalating. So in the beginning, we will start a little bit lower. And then as those rent bumps continue to kick in, we'll see an increase in that cash on cash. And we also see an increase when we re-lever the property, because we're essentially taking more expensive cost of capital and replacing it with cheaper cost of capital. So.
Yeah, great.
All right, so if no questions, I'll continue here. So one of the things that I know we have a lot of questions from folks is Cincinnati. Most people don't know a whole lot about Cincinnati. It's not a New York, San Francisco, big market. Everybody knows about it. So I want to take a minute just to kind of give you guys a rundown on why we like Cincinnati. We've actually been looking at this area for probably 2 years now and hadn't found anything until just recently. But again, that's just part of our process. And one of the reasons that we really like the area is because, as many of you may know, the Midwest was hit very hard by the downturn in manufacturing back in the 70s. So when everybody started moving manufacturing to China and everywhere else, the Midwest just really got hurt economically. And so it's taken 30, 40 years for that cycle to complete its process. And we're starting to see a tremendous amount of revitalization in these cities, Cincinnati, Columbus, Cleveland, Indianapolis. And it's really exciting, especially for someone like me who appreciates a lot of what happened there 100 years ago. And it's kind of exciting to see the revitalization of these cities. So Cincinnati in particular, as you see on the screen there, of the 31 largest US cities, Cincinnati actually has the lowest cost index for a business to operate in. So if you look at these other cities and you look at the cost of operating a business in Cincinnati, they are the lowest cost, which is a pretty cool thing because you've got a 2 million population, highly educated, skilled workforce, and it's the lowest cost. So you see a lot of folks moving into Cincinnati. I've got another slide, which I'll show you in a second, but Amazon, everybody knows who Amazon is, I think. They're spending $1.5 billion to build a hub right outside of Cincinnati. So that's a pretty good commitment level from a global company like Amazon. So there's a lot of cool things happening. There's 8 Fortune 500 companies that are headquartered in Cincinnati. So obviously there's, again, there's money, there's diversification, there's a lot of good things going on. The other thing that we look for in any city is we do want to see a diversified workforce and a diversified base for jobs. And we see that in Cincinnati. So we've got health and educational services, which are always good, solid performers, even in a downturn. We've got technology, retail trade can go up and down, and then manufacturing has actually been one of the strongest in that area as well. And we're seeing more manufacturing coming back into the Midwest. Not the same as it was 30, 40 years ago, but this is a more highly skilled technical type of manufacturing. And it's kind of interesting because you find that a lot of people who 30 or 40 years ago, their parents may have been on the factory line, they still live in the area and they have these skills that you can't find in other parts of the country where people actually still know how to work with their hands and do things. And so a lot of manufacturing is going back to the Midwest because they just can't find these people in, New Mexico or even Texas. So it's kind of interesting, that dynamic. But anyway, Rick, you can go to the next slide. Oh, here's I was gonna say there's the Amazon. So this just kind of gives you an idea of the major jobs nearby. Obviously, this is not a complete list, but kind of gives you an idea. The letter A, and sort of in the middle of the screen, is this particular property, Mt Airy. And then we've got downtown that's about 8 minutes away, and then some big employers surrounding us. So you can go to the next one, Ricky, which I think has so this is just a note about the $1.5 billion Amazon hub. They're about halfway through building this hub. It's going to be completed next year, and we actually already have 40 people in the complex working for Amazon, so that those new jobs, the 2,000 new jobs, has already started to affect even where we are, about 15 minutes away. So that's a pretty cool thing. You can go to the next one, Ricky. Okay, so one of the things that we look at, and I mentioned this briefly before, is kind of a median monthly rent, median house value, and household income. So monthly rent is, a rough barometer just to give you an idea. If you're close, if the rents are $300 and you're trying to charge $800, that's probably concerning. We're actually right now at $700, and we're planning to go $800, $900, maybe $950 on our. Sorry, I think I might have cut out there for a second. The median household value is the really important one. So this goes back to what we were talking about with regard to where we're buying a per unit price. So this is about 3 times, the median household value is about 3 times what we're buying our units for. So there's a nice spread between those two, which allows us to really capture that value. Now, the median household income is also important. Most of you guys may know that typically you want 3 times income versus your rent. So if you're charging $1,000 per month in rent, $12,000 a year, you want somebody to be making at least $36,000 per year. So we are in an area where we're well past that, and we actually did our lease audit a couple weeks ago as part of our normal due diligence process, and our residents are making 4.3 times our rent. So we are significantly above where we need to be, which is a great thing because we do believe that we have the income to support our rent growth. But it's always important to know that. So Rick, you can skip to the next one. So this is a little bit of a breakdown on the cost of living. As I mentioned, the cost of doing business in Cincinnati is the lowest of the 31 largest cities. This gives you a little bit of a picture from a cost of living standpoint, which gives a similar scenario where Cincinnati is much lower for somebody to live in. So the value that they get to live in Cincinnati is a lot better. Their dollar goes a lot further. So again, kind of going back to that median household income, some people would say, wow, $40,000 doesn't sound like much. How can you live on that? But if you relate that to the cost of living, it begins to make sense. And again, if you look at that that median home value, you realize, wow, if I worked in New York City, yes, I would need $100,000 just to survive. So the $40,000 in Cincinnati makes sense. You can go to the next one, Ricky. So one of the other things that's really important for us, similar to how we do the research in terms of vacancy and historical vacancy, is unemployment. So as you guys probably know, jobs drive multifamily. So you have to know your job situation in every market. Understandably, 10 years ago, there was a big spike. The economy went into a tailspin. We had a lot of issues. So this goes back to 1990. So it's almost a 30-year range of data. And what we look for here isn't so much that the spike didn't happen, because we understand that's life. But we want to make sure that the spike in our local area wasn't significantly higher than the state and the national average. So in this case, Cincinnati, for the most part, tracks the national and the state level. So we know it's not going to, fall off the charts when something bad happens with the economy. So again, we can be prepared. We basically know that it's going to track what happens in the surrounding area. So,
Robert, on that one, a question has come through. Let me just find it quickly. From Julian. Julian says so we have to bring the politics into it. Thank you, Julian. Julian says your president is continuously boasting on Twitter about the lowest levels of unemployment ever. Is this sustainable, given that it's such an important part of the multifamily space?
Right. Well, I'm not going to say whether I support or don't support our president. And I don't think he can claim credit for most of that stuff, but that's a side issue. So one thing I will say is that we do have a very strong employment market, regardless of what our Congress is doing. I think if they stay out of it, we'll probably be in better shape, but that's, again, a separate subject. So we do have a very strong job market. Now, I will say that there's been some factors that have contributed to that, namely, we do have very low cost of funds. The Fed funds rate has been very low, which has encouraged people to invest and continue to develop. So that's a plus. But I also think that over the last few years, you've seen some positive tax law changes, especially back in 2017, that really encourage people to invest in their businesses, which then, of course, causes employment to go up. And I think that's been a factor as well. But I also think that we're seeing a little bit of not a little bit, we're seeing a continued side effect of the global economy and technology, as especially countries like the US have really been at the forefront of that growth in technology and utilizing technology. So I think that's good. I think we're going to continue to see that, but we all have to remember that these things work in cycles. They always do. I don't know that we'll ever get rid of that, as much as the Fed would love to somehow eradicate ups and downs. So, I think, again, we're in the part of the cycle where things are good, everything looks great. At some point, most likely things will correct, and that's okay. That doesn't mean it's the end of the world. But for now, I look out and I say, what do I think? I don't know what's going to happen in 5 years. Nobody does. But I think for the next 12 months, for sure, we should continue to see a good market, and maybe further. But to some degree, we are all kind of at the same time saying we don't know, because in November, we're going to have an election and things could change. And, but even then, as I've told everybody, you could have a complete change in who's running the place. It's not going to affect it that much overnight. So I think that from our perspective, we kind of roll on and say, hey, at the end of the day, the supply and demand curve is in our favor. And so regardless of who's in power, who's running the country, we've got the supply and demand curve in our favor. And we've also got tax law in our favor too. So I think you're going to continue to see that positive momentum behind us. So anyway.
So Robert, just to quickly capture, so Sureshni, thanks for your question. She actually asked whether you think the elections will impact this investment? So I guess you've kind of answered that. So Sureshni, great question. I can see a lot of people have been watching USA politics of late, and understanding the impact on the economy. So Sureshni, thanks for the question. I think Robert's dealt with it. Robert, anything other specific about the election? I think you've covered it, but is there anything else you'd want to say to Sureshni about whether the outcome of the election will impact?
Well, I'm going to make a little bit of a joke, and I apologize if I offend anybody, but it is a joke. I'm voting for Bernie Sanders because I think if he gets elected, the market's going to crash and we're going to have some phenomenal opportunities. Okay, that's my joke for today. And nobody probably knows who Bernie Sanders is, but he's a little bit of a socialist, and he'll probably do all kinds of crazy things. Anyway.
I think you'd be surprised. So people looking to invest in the US, I think, will have a pretty good idea who your candidates are right now. Certainly are being tracked globally.
All right, so we'll continue here. So one thing I just want to point out on this economic highlights slide, probably for me the most important thing is average income growth. And we've seen a tremendous income growth in Cincinnati. These are the kind of growth rates that you typically see again in San Jose, California, or something where you'd expect to see this. But we've seen a tremendous income growth, and again, that's really the driving factor for us. Now, part of that is the revitalization of the city, but that's why we're here. That's what we're doing. So we want to tack onto that, and that's a big thing, big number for us. So anyway, just wanted to point that out. The other numbers are good, but I really feel like that is a tremendous driving factor because, again, in Cincinnati, people ask me to say, well, there's not a whole lot of people moving into Cincinnati. There's the population growth is relatively stable. And the fact is, there's not a whole lot of new places to build. So you're really taking existing inventory and you're rebuilding it or renovating like we're doing it. So you wouldn't be able to have a 10% growth rate because there just isn't any room for new inventory in the market. Now in the suburbs there is, in fact, Westchester, which is just north of us, they've had about a 25% growth rate in population, but they've got room to add new units and new places. So again, when you're looking at a revitalization type story, which is what we're looking at in this case, you want to see that average income growth because that's what's going to drive those rents upward. So anyway, we can go to the next slide. Okay, so just kind of digging into the property specifically, there's three opportunities here, sorry. Location, management, and renovation. So the location, as I mentioned, this is at the edge of a revitalization area. It started about 20 years ago. It's now reached up to where the views of Mt Airy is located. And that's really what we are partly basing our investment thesis on, is that we are seeing people coming into this area, the Mt Airy area, then they want to find a nicer place to live, but they don't want to pay twice the rent that's 5 minutes away. So they're getting pushed out of the higher rent area and they're looking for a place that they can go that's safe, that's nice, that's renovated, and they can still afford it at the end of the day. Second thing is management. The project has been self-managed for the last few years, and the guy who bought it, a very nice guy, we've met with him, talked to him a couple times. He's a local to Cincinnati. His business plan is basically finding projects that are kind of broken and they're in a rough area, go in there, buy them, fix them up, and hopefully hang on to them until the area gets a little better and then flip them to somebody like us who actually wants to operate them. So, I walked into the project and said, why wouldn't he keep this project? There's so much opportunity, there's so much meat on the bones, but that's not his business plan. And so that works great for us. So of course, we're gonna bring in professional management, we're gonna do a lot of marketing, and we'll be able to, again, drive the revenue on the property. The third piece is renovation. There's a lot of opportunity to go in, renovate these units that are fairly old on the interiors. So we've got a healthy renovation budget of about $1.75 million. And we're going to be able to go in there and really turn them into some nice units. So that's kind of the summary: location, management, and renovation. Rick, you can forward to the next slide. So a couple details about the property. I won't bore you with too much of this, but essentially it's a 1973 build. There's 3-story, actually it's 4 stories. We should correct that. There's 4-story buildings, no elevators, so it's walk up. It actually goes up 3 and down 1. 282 units. It's a modified bitumen roof, which has been replaced in the last 10 years, so we don't have to worry about that. Standard construction. Really the only issues that we found here, potential issues, I should say, is the plumbing is a little bit older. So it's not something that you would ever go through and replace, just doesn't make sense. But it's one of those things you just have to keep an eye on, and as needed, make sure you have money in the budget to replace and or repair. So everything else is good. One of the big things that we always look for with a property like this that's up north is making sure that the boilers are in good condition, because again, those are the kind of thing that's a major CapEx item. They have been recently replaced, and every single building has a backup boiler. So it's actually an unusual situation in that they are relatively new and we have a backup boiler. So kind of nice to have that out of the way. And then the last thing, again, some of you may know, but a lot of these older buildings that were built in the 60s and 70s had aluminum wiring. That's had to be fixed because of the safety concerns that came about a few years after that. So that has been taken care of at this property. Basically what it is, you take the end of the aluminum, you take off the plug, you replace it with some sort of a mitigated copper ending, and then you're safe. There's no more issues. So anyway, that's kind of the property detail. There are some pretty cool amenities. We've got a clubhouse, business center, outdoor barbecue station, a couple of playgrounds. Every building has laundry facilities. There's some nice nature trails. One of the things that we are going to be adding is a dog park. As you guys know, there's a lot of people with pets these days, and that's a really important amenity. So we will be adding a dog park. The area around us is fairly well populated with good retail. So as you can see on the map, Kroger is kind of the local strongest grocery chain in that area. They're based in Cincinnati, so there's quite a few of those around. Target, I'm sure you guys have heard of. Lowe's is a national chain, probably heard of them too. And then of course everybody knows Starbucks. We always joke that we never buy a property that's more than 5 minutes from a Starbucks, but it is kind of true in the sense that, you know, these national retailers do their research and they obviously want to be in an area that makes sense for them. So not that we solely rely on that, but there's a lot of research that goes into where they put their locations. Now, the one thing I will say that's kind of unique about this particular project, kind of cool actually, is that the neighborhood just to the southeast of us is actually the edge of that revitalization. And if you go into that town, north side, you're going to see all kinds of people that have come in. They're buying the old houses, they're fixing them up, painting them. It's really beautiful. Lots of coffee shops, restaurants, small businesses that have come in there. So it's kind of neat, actually, in one sense. You don't have a Starbucks, but you do have quite a few of those local coffee shops, et cetera, that are in that area. So again, this story is kind of unique in the sense that it's a revitalization sort of thesis that is really driving this. So anyway, we can go on to the next one, which I think is, yeah, there we go. So unit mix, we've got kind of a split between 1 and 2 bedrooms, which is nice. That we always like to see that. The average square foot of these units is fairly similar to the other ones in the market. Again, you don't want to be too small or too big. And then our average effective rent is just under $1 a square foot, which for probably most of you that, well, at least for me, that's dirt cheap, but it is Cincinnati. So you can jump to the next one, Ricky.
And just as a rough guideline there, you can just sort of divide by 10 to get to square meters for any South Africans wondering.
So here's the floor plan for, well, you can kind of scroll through, but we always put a floor plan in here. One of the things that we do look for is just to make sure that these floor plans are not functionally obsolescent, meaning there's something in them that just doesn't work and that we'd have to change before we even try to release it to a better quality resident. So they're very nice floor plans. They're solid in terms of just the structure and plenty of closet space, and there may be even some space. We were looking at potentially adding washer dryer units to these particular units. So, you know, lots of room to make them look better without making major structural changes. So in terms of the business plan, as I mentioned, there's kind of those 3 opportunities. One is below market rent and increasing that to the market. So without doing any capital expense, we can increase those rents just by continuing to manage the property well. Which leads us to the second thing, which is going from a self-managed to a professionally managed property. We have a company that we've used before on our other 2 assets that are about 45 minutes away on either direction, and they will be continuing to work for us on this particular property. And that's going to help out a lot, just having better marketing exposure and professional management. And then the last thing, of course, going from more of a C class to a B class, which is really partly due to that revitalization process that's in place around us. So you can skip to the next one. Now, one of the most important things, which Ricky mentioned, he spends a lot of time on this, and it's extremely important, is understanding the competition in the market, both from an existing standpoint and also a potential standpoint. So what we like to do is both from a online and as well as driving around and actually visiting every single one of these properties. We generally visit 10 to 20 comparables in order to develop this understanding of the market. And what we're trying to do is essentially go in there and see what the competition is charging for an existing similar unit in terms of renovation, as well as the units that have been renovated. So some of these properties have been renovated, they're charging a higher rent. Where are they at? It gives us an idea where we can go. Now, sometimes they may not have done as much as we want to do, so we might be at the front edge of that. But most of the time, there's somebody that's already done what we're thinking of doing. They've already raised the rents, and we're coming in behind them and simply adding to what they've already done. So it's not like we're coming up with these numbers and saying, hey, we think we can do, $2 a square foot and everybody else is $1.20. There's already folks in the market that have already achieved these rents, and we're coming in and saying, hey, you know what? They've proved the model. We want to come in and simply add to it. So you can go to the next one, Ricky. So kind of the idea here in terms of the capital improvement is that we want to come in there and add LVT flooring or LVP, depending on what you call it. But basically the vinyl plank flooring that is very common, very sturdy, very resilient. So we come in and we do that on the bottom floor. We want to upgrade the tub surrounds in the bathroom. And we found that that's one of those things that kind of takes a C property to a B feel, even though it doesn't cost a lot of money, usually about $1,000 to do that, but it just completely changes the feel of that bathroom, makes it feel like it's a A or B quality bathroom. Along the same lines, framing the bathroom mirror, adding cabinet hardware, and then adding dishwashers to some of the missing units. Quite surprised that they didn't have dishwashers in 2020. So we're going to obviously take care of that. And then the last thing is a technology package, which we may or may not do. That's actually one of the things that we're going to test the market with. But we have found that in a market where you have a lot of millennials, folks are willing to pay a little extra in order to have a door lock that's Bluetooth controlled, so they know who's coming in and coming out. They can also control their thermostat via their phones, so they can change the temperature and kind of have some control there. So we'll see how that goes, but that's an opportunity, I think, as well. This is more of a detail. You guys can take some time if you want to after the call to look at this, but we're basically breaking down what we want to do on a budget and how the money's spent. And then from a timeline standpoint, the big picture here is it's generally 0 to 18, 0 to 24 months to accomplish what we're trying to do from the renovation standpoint. And then at the end of that, we will go back to the lender and we will do the supplemental loan or refinance. Right now, supplemental loan is what makes sense because of the interest rate environment. And then we'll be able to return that capital back to you as the investor. So Rick, you can skip to the next one. There's a few pictures of the existing interiors, and then the good part. So kind of the high level financials, we are purchasing the project for a little over 15 million. Then we are also raising about 6 months of working capital, which I mentioned to you initially, so $600,000. Then we've got a $1.7 million capital improvement budget, and then we have our closing costs. Now, including in the closing costs is a 3% acquisition fee. That's what we charge on the front end for putting the deal together. And that essentially is what covers us for the next 5 to 10 years, because as I mentioned, most of our profit, if you will, is all tied up in that project until it's sold. Sources of financing are debt. We've got an $11 million loan, and we are raising just over $7 million. Now, from a loan to cost standpoint, I think that's about a 60% loan to cost. And that's fairly common in our projects. We generally are going to be about 55 to 60% loan to cost. So again, that goes back to our initial thesis that we tend to be more on the conservative side, and we like to have that leverage fairly low in order to be able to stress test the property and still cash flow. All right, go to the next one. So a lot of detail on this 5-year projected P&L. I won't go through all of it, but just kind of give you some highlights. One of the things we always do is we project a little bit of a higher vacancy and collection loss in year 1 and 2, just as we're going through and renovating those units. A lot of times we're also changing out our resident for a higher level. So there is some vacancy, and we also have the vacancy in order to actually work on the units. So we always project that and then typically kind of ratchet it back going from year 3, 4, and 5. The other thing that's a big factor for us is taxes. Normally taxes always are low, especially in an increasing valuation market like we're seeing today. So as you notice on our projections, we're going from $78,000 a year up to $280,000 a year for taxes. So that's a big jump, fairly common. And that's one of the things that's very important to make sure that as an operator that you do your homework and make sure you know what that is, because obviously if you're wrong and you're $100,000 off, that's going to affect the projections quite a bit. So we spend a lot of time, we dig into that. We have experience in Ohio. A lot of it depends on the county that you're in. You have to know what the county's perspective is. You also have to know what the school district is doing in terms of going after purchases and achieving increases in tax rates. So we spend a fair amount of time doing that. We know the area around Cincinnati fairly well. We feel pretty confident that even though we put the $280,000 in there for year 3, that will probably be significantly below that. But again, just wanting to be conservative, we roll through with the 280 and assume worst case scenario and feel like, hey, if we can still generate a good return at this purchase price, then we'll do that. So that's kind of a couple of highlights there. You can go to the next slide, Ricky. So on this particular project, we are assuming an existing Freddie Mac long-term 10-year fixed rate note that was put in place a couple years ago. The interest-only period is just about done. And so all of the projections that you see on this particular project actually include a fully amortized loan payment, which normally is not the case. Normally when we do a project, we get about 3 years of interest only, which helps our cash on cash return. So that's another reason why we were pretty excited to be able to do this deal, because it still gives a good cash on cash return while we're making a fully amortized loan payment. The interest rate is a little bit high. It's 4.79%. If we were to do this deal today, we'd be about 3.5%. We have looked at potentially paying the loan off and getting a lower interest, but I think for the time being, the cost is still slightly higher than just keeping it and rolling forward. So again, that math may change, but for now, that's where we're at. We are anticipating doing a supplemental loan, as we mentioned, in year 4. We target year 3. We project year 4, again, trying to be conservative. And that would allow us to return 63% of the initial capital back to our investors at that point. So you can go to the next slide. There's a few assumptions here, a lot of detail. Yeah, that's okay. We can skip through that. It's a lot of fine print, but there is a lot of good information. So if you guys want to take the time and kind of understand some of our thinking behind all those numbers, that's a great place to go. And then the projected returns, of course, is what everybody cares about. So this is what it looks like on a year-over-year basis from a cash on cash as well as a return on capital. And the 5-year sale is a projection that we do because a lot of folks, they kind of tend to think in terms of 5-year hold. So we did that as a projection. That doesn't mean we're going to sell it in 5 years, but it kind of gives you an idea what you could expect to see on a 5-year hold. So you can kind of see where those cash on cash returns come into play as well as the return of capital. All right, Rick, you can go to the next one. And a couple of nice pictures. I'm trying to think if there's anything on the FAQ. Some of that doesn't really apply, but
I think relevant for them.
Yeah.
Maybe just that the distributions take place quarterly.
Good point. Yes, good point. All right, so you can go to the next one. So a little bit about REM. We mentioned a little bit about who we are, kind of the gist of it here. We're experienced, we're fairly conservative. We spend a lot of time on due diligence. One of the things that I think factors into the overall perspective of REM is I started 20 years ago in New York City, worked for a couple guys there. When I left, we were managing about $1.5 billion in assets. We had done projects in the office and multifamily space. We would do, all kinds of different projects. And then I moved to Tampa, worked for a real estate investment trust based out of Raleigh, and kind of focused on Tampa, but also did some work all over the eastern half of the U.S. in different locations where they were based. And at that point in time, I think we had about $4 billion under management. And so I was basically mostly focused on the asset management side of things, but that's kind of my background. And Ricky, if you want to go to the next slide, that's really what I'd like to spend a minute talking about briefly. Kind of goes back to what I said initially, how we look at risk. We're sort of a risk-based approach to investing. And again, the question is, high risk, low risk. We have a little bit of a lower return, but we feel like the risk is more than compensated by the drastic reduce in risk. And so how we do that is stress testing, which we've talked about, identifying risks in the market. So, in this part of the cycle, we're seeing a lot of people that are overpricing, so we want to be careful about that. Lower leverage, we talked about that. Having industry experts. So, I've been at it for 20 years. My partner Rod's been at it for 40 years. We've got, people that really know what they're doing. And then on the underwriting side, Ricky and I spend a lot of time kind of tweaking things to make sure that we leave room in there. So from the taxes to the vacancy to just different expense line items, we like to make sure that we're fairly conservative. And overall, that helps us to really get the right type of a risk-based profile. So we can still get a good return, but we feel like we've taken a lot of that capital risk out of the equation. That's really our goal. So Ricky, I don't know if you want to add to anything to that, but that's pretty much the gist of it.
No, I think that was great. Thank you very much. Lyndon, I don't know if there's any other questions on your end. We still got
I think we might have lost them, right?
We're officially hosting the meeting.
Oh, yeah, right.
Hi guys. Yes, you are officially hosting our meeting. I think what has happened is Lyndon has been plunged into darkness due to load shedding currently. Oh, there he's back. So one of the questions that did come through was just, are your dividends paid quarterly on a predictive cycle, so specific months every year, or is it dependent on when the investment into your project takes place?
Good question. So it's always on a calendar quarter. So end of March, we'll pay in April, and therefore thereon.
Perfect. Thank you.
Yeah, sorry about that, guys. So for our South African audience, you're very aware what's just happened. It hit 8 o'clock, which means load shedding in my part of South Africa today. So my power went out. Luckily, I have a backup, which kicked on my internet again, but apologies for that drop for a minute or two. To Robert, that's probably a new concept for you. So if you're going to be dealing with a lot of South African investors in the future, at the moment, load shedding, as they call it, is a part of our lives, where on many days we might lose power in different regions for 2 or 3 hours a day. I'm sure is used to it. There's no problem with it.
I was going to say, I'm semi-relieved that it happened with you guys online. I was beginning to think Robert doesn't believe me when I tell him the power's gone out in Cape Town and I'm finishing my work.
If they could just get Trump over there, I'm sure he could solve it.
Absolutely, I'm sure he could too. So firstly, Ricky and Robert, thank you very much for going through that presentation. Really interesting deal. So there were 2 bits for me that are quite unique, I think, that are coming through from you guys that we don't see very often. The one is obviously that that after 3 to 4 years, that secondary refinancing without flipping immediately, as Robert mentioned. And the second one is your loan to value at 60% is certainly conservative compared to what many of our sponsors are, who play at about 68, between 68, 70%. And I think that really speaks to your conservative nature, the fact that you want to really be able to ride out any downturns without having the threat of a bank coming in and taking over, which, as we all know, is the worst possible outcome on any investment like this at all. So that for me was really interesting. And then I also appreciated your 3 different strategies as to how you can add value. The fact that you're in the right area, change management, and also the additions, the changes to the underlying business model through your capital plan. So that gives, as an investor, I think that gives a bit of surety that any one of those 3 could have a significant impact. And the fact that they've got 3 horses in the race really gives them a good chance here of, in addition to the cash flow, but really getting some great value out at the end. Lee, I'm not sure if there were any other questions that have come through while I was offline.
No, Lyndon, it was just that one about the dividend payments.
All right. I also have noticed that, ironically, we lost about 20% of our attendees at the same time. So I'm assuming that that was a fairly high significant bunch of them that were out of South Africa tonight, and that they've also dropped off due to load shedding. So apologies to those who dropped off. And if you're from anywhere else in the world, apologies. This is something we as South Africans have got used to in the last 6 months. While some of our power stations globally go through intensive repair, we have these momentary relapses every day of power getting shut off in parts of the country.
That's the story. That sounds like the story we tell ourselves to stay sane. I don't know if that's the real story, but the last 6 months, it's almost been 5-6 years.
Yeah, it's long refurbishments. It's a value add play that hasn't worked out quite the way it was meant to.
They definitely are under budget.
Anyway, without getting, we've successfully dodged US politics tonight, and let's try to do the same with South African politics. The final question I have for you guys is: you said that there was a total raise of, I think, about 7.5 million. How far are we at the moment? What are your timelines in terms of when you need to be closing this, and just how much is available at the moment so that we can let our investors know, firstly, their urgency. And my understanding is this deal needs to close pretty quickly, so investors don't wait, get online and get this one into your portfolio pretty quickly. And then totally what amount is there currently outstanding?
So we've got about 45 days until we close. We would like to get all of the capital in the escrow account by the end of this month, maybe first week of March. We actually are fully committed on this project, but as I always tell everybody, it's a first come, first serve. So when the money hits the bank, for the most part, that's when it counts. So we still have room to go, and obviously would welcome anybody that's interested to join us. So.
All right, guys, so if you've ever heard a call to action, that's one right there. This deal already has fully committed, so people who have stated that they want to invest but they haven't sent the money through yet. As you know, at Wealth Migrate, as soon as the money lands in our bank, we keep the sponsors updated so they can count on that money and add it to their capital stack. So this is really a call to action. This is a great one for your portfolio. If you're interested in multifamily, if you like diversifying across new sponsors, which, as you know, is the only advice we ever give, is diversify rather than actually telling you what you should be doing. We just believe in diversification within your portfolio, both in deals, in sponsors, and of course in asset classes. So, I think if this is something that would meet your investment criteria, please reach out to us directly. Otherwise, go straight onto the platform, you know the process, and complete your investment. And we are looking forward to a very long and great relationship with REM Capital. Guys, thank you for joining us tonight, and really excited about this first raise. So let's get this one done and dusted, and then we can move on to a long history of many more in the future.
Our pleasure. Thanks.
Thanks for having us, Lyndon. And if there's any follow-up questions or anything from investors and they want to reach out, it can obviously come through you, but we're open to that. So let us know where we can support the process.
We will do that. Ricky, Robert, thank you very much. Lee, as usual, always great to have you online. Great to have you back in South Africa. Hopefully this trip I might get to see you, but who knows. To all our investors who have joined us tonight, thank you very much. We know you could have spent this hour somewhere else. Instead, you chose to be here with us. We really appreciate that. And very excited, as I've said, to have REM Capital joining the Wealth Migrate team and partnerships. From all of us to all of you, have a great night or great morning or great afternoon, depending on which part of the world you're in. And Robert and Ricky, thank you very much and goodbye.
Thanks,
guys. Bye.